Hello, my name is Matt Brennan. I'm Head of Passive Portfolios here at AJ Bell, and welcome to our 2018 second quarter review. Share returns were a mixed bag in the second quarter of the year. Regions such as the US, Europe and the UK performed well, whereas areas such as Africa, South America and parts of Asia saw negative returns. So what has caused these moves? Currency movements were a large part of returns, especially for a UK investor. The US dollar went up strongly, caused by a number of factors. Firstly, the US central bank has repeatedly increased interest rates. The higher returns you can now get in a US bank account make the currency attractive to overseas investors. Secondly, as people worry about a trade war and the effect this might have on global trade, investors often shift money into the US dollar, which is seen as a safe haven in turbulent times. In general, a move up in the dollar is good for a UK investor, as the value of any investments made in dollars are worth more when converted back to pounds. However, one part of the world where a strong dollar is perceived as bad news is emerging markets. These regions often borrow in dollars, where they can access lower loan rates. However, as the dollar strengthens, the amount they owe in their own currency increases. This puts pressure on the financial health of the country, hurting share prices. Currency markets are notoriously hard to call, so we make sure the funds have investments spread across different countries. Another driver of market returns has been the building trade war between the US and China. So how do trade wars start? When one country wants to make another country's imported goods less competitive, it applies tariffs. This can boost the domestic economy, as local companies have the opportunity to fill the gap. The standoff between Trump and China has arisen due to his view that China has benefited from years of underhand practices, such as stealing intellectual property or stopping US investment. If a country imports more goods than it exports, it is said to have a trade deficit. On the other hand, if it exports more than it imports, it has a trade surplus. China has a trade surplus of around $375 billion with the US, and Trump wants to claw some of this back to help the US economy. He is hoping to claw back at least $100 billion of this through tariffs. For now, we believe a lot of the current hot air is tactical to strengthen each country's negotiating position. However, if an all-out trade war was to erupt, it would be more than likely negative for share prices across the globe. In the event of this, we would consider adjusting the fund's positioning to reduce the impact on returns. On more positive terms, technology continued to perform extremely well, up almost 13% over the last 3 months, bringing its return over the last year to an impressive 29%. As share prices increase, the sector is of growing importance in world equity indices. In fact, over the last 5 years, its weight has doubled in the MSCI All Country World Index, a well-known global share price index. Share price performance for this sector has been mainly driven by growing profits, which perhaps alleviates fear that the sector is getting expensive. This was the case in 2002 in what was known as the dot-com bubble. Technology companies tend to deliver higher returns but carry higher risk. This is why we have investments in the sector in the balanced, moderately adventurous and global growth funds, but avoid large holdings in the cautious and moderately cautious funds. We are pleased with how the funds have performed over the last 3 months, ranging from just below 3% for the cautious fund up to over 7% for the adventurous fund. The funds have now passed through their first anniversary, giving us a 1-year track record. Over the last 12 months, we have seen increasing returns as we move up the risk scale, ranging again from just below 3% for cautious to just below 7% for adventurous. The main change we made to the funds over the quarter was how we invest in property. We have blended our holding in the iShares UK Property ETF with short-dated inflation-linked bonds. It lowers the overall risk and it reduces the fees we pay to third-party managers. Since the end of the financial crisis in 2009, global stock markets have risen by over 300%. This is one of the largest rallies since the end of the Second World War. Despite strong market performance, valuations do not appear overly stretched, and we continue to invest in equity markets. However, we believe in the current political landscape, it is important to remain alert to developments and ready to change our positioning if necessary. We expect to see bumpier times ahead, and therefore feel it is important to be invested across different countries and asset types. As ever, we would urge you to do your own research to ensure that any investment you select is appropriate to your attitude to risk and your financial circumstances and objectives. If you're unsure about any of this, please speak to a financial advisor. Thank you very much for watching.